In today's video, we're going to look at factor investing and which factors beat the S&P 500. And it's a real robot wars, battle bots, ding dong battle, trying to find the best factors, where factors are providing additional screening on the S&P 500 to look for areas of potential outperformance, such as value, momentum, or dividends. So I've got my data from the S&P, and this is the website here. They do a monthly factor document. I'll put a link in the description. They're saying that over 15 years, the number one factor is buyback. So this is companies that are purchasing their shares. There's then fewer shares in issue, and if it's quality companies doing this, then they seem to perform pretty well. Now, unfortunately, in the UK, there's only one ETF that captures this factor, and that ETF only has one market maker, and I've got this data from justetf.com. So although in the US you can use something like ETFDB to find some ETFs that look at this factor, in the UK you're a bit limited, and some brokers don't actually stock this. So then I've gone into Portfolio Visualiser. I'll put a link to a video where I explain how Portfolio Visualiser works, and I've compared S&P 500 to buyback achievers, and the results are, well, pretty much neck and neck. So it's not really that convincing an argument that you should divert from something that you know and really understand to something that's a little bit out of the ordinary. Okay, so next up we've got Dividend Aristocrats. So these are US companies that have increased their dividend for 20 years or more, which is a pretty phenomenal achievement. So they've got 15-year very strong growth there, but on shorter time frames, not so good. Here are the top 10 holdings of the fund. You've got some oil companies in there, a bit of retail, and then here's how it's done monthly over 3 years. I'll put a link to the video where I explain how I sample the data monthly and then get some trend lines, and that really helps me to find the best ETFs. Next up, we've got low volatility, high dividend. So the idea here is that prices are meant to be fairly stable, and then you've also got good dividends as well. So some quite good defensive factors, and over 12 months this is done really well. The chart here is not quite as powerful, and we've got the top 10 holdings here, stuff like Philip Morris, some maybe more mature industries and companies, AT&T as well. Next up, we've got quality. So this is the returns of the quality ETF, but it's before any fees. So over things like 10 years, 5 years, there's a small beat over 5 years, but actually if you took off the product fees, then it wouldn't beat it at all. Here's the 3-year graph. It's pretty good, but it's kind of not done so well recently. Top 10 holdings here, some well-known names, and then a bit of a curveball with Meta Platforms. I wouldn't call that quality, and the problem here with factors is that sometimes someone's definition of quality doesn't match your own one, and this can mean it's just a bit confusing what they have in the fund. Next up, we've got momentum. That's not done really so well recently. The problem here is that this one rebalances every 6 months, so when markets are choppy you can end up with rather funny holdings, and it can take a while to really adjust. But if markets are trending quite strongly around something like technology, then the fund will perform well. So we've got probably the best tech company at the moment, Apple. We've got some oil and gas, we've got some healthcare in there. So yeah, quite an interesting mix, and some quite punchy weightings as well. But with this one, it should pivot to the better performing shares in the S&P 500, just sometimes not quite with the timing that you'd want. Now this is really interesting: quality, value and momentum. So you've got to make all the criteria there to be included, and this beats across all the time frames, and the volatility is lower again across all the time frames, and the graph here pretty phenomenal. So top 10 holdings again, fairly concentrated. We've got some names that we've seen before in there, a bit of healthcare, Apple, a bit of oil and gas as well. So this one is well worth looking at. The 3-year Sharpe ratio is here 0.62, which is the strongest of all the Factor ETFs, and it beats the Sharpe ratio of the S&P 500. Healthcare has the best Sharpe ratio, that's risk versus return, over a 3-year period. But sectors can kind of come and go, and the idea is that factors can pivot between different sectors. And there's also this US quality dividend growth, which it's kind of invented by Wisdom Tree, so it's interesting, but it's the ETF provider is then also making up the index, so there's a bit of a conflict there. So quality, value, momentum, it's really investing in the sweet spot, in the interaction between these 3 areas. So where you've got this wonderful Venn diagram that I made myself, where it all intersects, that's where you invest. So now we've got value, which is one of the bottom performers over 15 years, 2 percentage points lower before any product fees. And we've got companies that are arguably losing market share or not innovating, so the price comes down, they're supposedly good value, and yet there's concerns as to what they're actually going to do in the future, whether they're going to grow. The chart here, it has gone up a bit and then it's kind of consolidated. So the issue is that if we go back to Portfolio Visualiser, over 15 years, massive underperformance. And I get really annoyed when people talk about how great value is, because certainly recently that's not been the case, and I doubt that people will be able to hold on to a value factor for this long and see such huge losses. People generally will doubt themselves and the strategy during these prolonged periods of underperformance. I mean, personally, I'm just not that patient, and when people talk about value, the stats don't back it up. So when looking at factors, it's really important to do your research and pick the right benchmark. So here we've got a comparison of S&P Small Cap 600 versus the Russell 2000, and the S&P beats Russell by 1.8 percentage points over it's over 20 years here. So it's a pretty convincing beat, and the reason why is this financial viability criteria, where S&P will only include things in its small cap ETF if they've got positive earnings in the most recent quarter and the sum of the last 4 quarters earnings is also positive. So it's got quality on it. Russell has no filter here whatsoever. The good thing about S&P is that it's independent of stock exchanges like NASDAQ and New York Stock Exchange, so it's prepared to exclude rubbish companies, whereas NASDAQ as a company, as a stock exchange and as an index provider tends to just put everything into the NASDAQ 100 regardless of profits or any sort of viability criteria. And when I look at small cap, I got a growth rate of 9.85% over 15 years. Here's some more recent data. Within small cap, I think there's a lot of story stocks with no hope of ever making a profit. There's a lot of overpriced growth stocks that are unable to scale to the mass market, so they'll just stay within a niche. There's poor quality stocks with high debts, so the company as a whole, it would cost a lot of money to buy it because you've got to pay off all the debts, but it would have a low market cap. There's also small cap value stocks that are losing market share and are unable to compete against larger, more powerful rivals. Now, when I put in S&P 600 versus S&P 500, it actually came out very similar. So that kind of shocked me, but the small cap is much more volatile here with a standard deviation. And then with the Russell 2000, it starts to go wrong in mid 2018, and this is because recently there have been small cap initial public offerings that have been really poor quality, and ETFs like the Russell 2000 are forced to buy them. So you can just float any old junk on the market and a tracker will have to buy it, and that's really hit this ETF quite hard. So now we've got factor performance over time, and this yellow is value, and you can see it does well way back in the early 2000s, but it's hugging the bottom in 2018, 19, 20. We've got minimum volatility, which is sometimes the best performer, but then sometimes the worst performer. So it tends to go from one extreme to another. Quality, bad run here, sometimes does well, but it's quite a patchwork quilt, and there's not really anything that's popping out to me as though, oh my god, this is just an amazing factor. Probably the one that I like the best is that Dividend Aristocrats 20 years of dividend growth. Unfortunately, that's not covered by MSCI. It's got high dividend yield, but not quite the quality around the dividends that I would like to see. So the conclusions: with factors, you need to be in it for the long haul. Things that top the performance table this year might be in the bottom quartile next year, as the dashboard shows. The devil is in the detail, and we saw that in how S&P and Russell approach small caps, and you've got to get the right one. Pick a factor that you feel comfortable with, you really understand it, and then research that further. So what is value? Does it mean forecasting to make a loss in the future and no dividend? I mean, exactly what is it? Transparent factors do deserve your attention, and 20 plus years of dividend growth is difficult to falsely manipulate. And how you measure growth is really important. 15 years, it's kind of a bit arbitrary. You should really be measuring from peak to peak or trough to trough during an economic cycle. So including data from 2003 to 2006 will show value in a more favourable light. However, I still feel value is not worth investing in. So I hope you enjoyed the video. Give it a like, let me know any comments, and subscribe to the channel.